Hello everyone, myself Sampath Kumar. In this video, we are coming up with a quick revision for costing. This is especially useful for CMA final students. This can also be used for CA final if you want to explore more different types of questions and all. But basically the questions that I have chosen are from CMA final study material. Okay, so I have already solved the questions because I don't want to waste your time in calculations or the things that you can handle on your own. Efforts will be made to revise many important questions without going into the calculation part. Only the conceptual things will be discussed. And one more thing, if you have already touched this subject earlier or gone through the study material and tried solving few problems, then it will be useful. But if you are an absolute beginner and watching these costing classes for the very first time, you might find it very difficult. So on that note, let's start. As I said that these are more of a revision videos, so pay utmost attention. Don't dilute your attention in anything else because I will be going at a very fast pace. So there's one question. Most of the times what I have tried to do is I have tried to write the question in the sheet itself in a normal way. But if you want to go through the entire question, I would recommend that you open your study material in front of you. While I read the question, you just have that study material in front of you. Then there will not be any confusion. So there is a company who is forecasting their sales to be 25 lakhs for the upcoming year, and their COGS is 18 lakh. So which means that the inventory turnover ratio is 9 times. So they have a inventory turnover ratio of 9 times. So they are getting one proposal. The proposal is that I want to increase the inventory turnover ratio to 12. At the moment, the inventory turnover ratio is 9. They want to increase it to 12. So when you are trying to increase, so you have to make an additional investment, and the cost of investment is 10%. So he's asking very simple question. Maybe it can come for 1 mark or 2 marks. So what is the saving in that? So we need to know what one formula. The formula is inventory turnover ratio. The formula for the inventory turnover ratio is a COGS divided by an average inventory. So as per their existing inventory turnover ratio, the COGS average inventory is 2 lakh. So how it is getting? COGS, it's given in the question 18 lakhs divided by existing inventory turnover ratio is 9. So which means that their average inventory in their warehouse is 2 lakhs. So they are maintaining 2 lakh worth of stock all the time with them. They are proposing that they will increase the inventory turnover ratio to 12. So if that is the case, they will be spending, there will be inventory with them all the time of 1.5 lakhs. So at the moment they are maintaining inventory of 2 lakhs. Now proposal, because of increase in the inventory turnover ratio, it is coming down to 1.5 lakh, which means they are able to save 50,000 in terms of the inventory that they have to maintain. So what you can say that, so what is the points are just decreasing the inventory, but there is no other impact. So when you're decreasing the amount of inventory that you have to maintain, which means that money you can use it for somewhere else also. So you are not blocking your money in the inventory. So you are saving 50,000 rupees in the value of the inventory. So your investment is, as I said, 10%, that is their interest rate. So 5,000 will be the saving if you can increase your inventory turnover ratio to 12, which means that you sell your asset quickly. That's a point here. That's one question number one, very simple question. Coming to little complicated questions. Now, as in how we move, we will be having complex questions. So there's a company that they are selling 2 products. One is Splash, another is Flash. So there are 2 types of products which they are selling at 3 rupees and 4 rupees respectively. So I would suggest for a final student, whenever we read a particular question, which I have done in my notes, whenever you read a question, as in how you read the question, you try to prepare a notes. Notes doesn't mean that you will come back and read. In the examination hall also, at least, okay, there is a company, so they are having 2 products, X product, Y products. So when you can simplify that question and write it in your answer, so that will make your analysis a little easier. So that's what I have done it here also. So there is a company who is selling 2 products. One is Splash, another is Flash, at 3 rupees and 4 rupees respectively. So they're having a strategy. The strategy is they want to make a sale, like they are projecting their next year sales to be Splash 7.2 lakh, Flash 3.5 lakh, and the break even point is 60% of the total sales of each product. So each product will reach its break even point at 60% of their total sales, which means that if I'm selling 100 rupees, so till 60% I will be only recovering my fixed cost. That's what we say it, right? Break even point is a point at which you are not incurring any losses or profit, which means still 60% there is only fixed element. Remaining 40% there is a margin of safety, that is where you are earning a profit. So they are saying next year I am projecting my sales to be 7.2 lakh for a product A, Splash. For next product Flash, 3.5 lakh. So that is their projected sales, and they are expecting that they want to reach the break even point at 60% of their sales. Profit, they want to earn a profit of 69,120 for product Splash and 17,500 for Flash. So they are giving individually what is the sales to be achieved, individually what is the break even point, at what level they will reach the break even point, individually what is the profit that they would like to arrive. And then they have a costing system, like they are incurring fixed cost of 1,08,000 for Splash and 27,000 for Flash. I'm just reading out the question, but I'm writing it in a simpler way so that when we come back it will be easy for us. So they want to reduce the selling price by 20% for Splash and 12.5% for Flash. So these are the basic information that is given in the question. So we write it in a simpler way so that we don't keep looking for things that we require. Okay, so everything is in one place. It might take some 30 seconds to 45 seconds to write it up, all these things. Now coming to the main question, the question is saying how many number of units they need to sell to break even. So just they are saying 60% of the total sales is a break even. So what is that 60% of sales? I want to know. And then what is the cost reduction they want to achieve? So they have given the existing cost. So this is their existing cost. This is their existing cost. So they are saying that, okay boss, I said I want a profit of 16,000 and 17,500 respectively. So what should be the reduction in my fixed cost so that I end up getting that profit? Okay, so whenever you are getting any question relating to marginal costing, there are few things which you always have to remember. Any question that is given, you start with selling price, deduct variable cost, you will get contribution minus your fixed cost, you are getting profit. So these are the major things that you need to remember. So contribution divided by selling price will give you a PV ratio. Again, what is a break even point? So break even point is a point at which there is no profit, there is no loss, which means that we will only recover fixed cost divided by PV ratio, or fixed cost divided by contribution per unit. So these are the basic formulas. Again, this is not a regular class, so I am not going in detail, and I am assuming that you must have gone through all these formulas, right? Till this far it is clear. And coming to the next point, see, if this is your total sales, if it is total sales and this is 60%, till 60% if it is a break even point, which means the remaining 40% is the margin of safety, which means till 60% you are just recovering your variable cost. Obviously you need to recover your variable cost, along with that you are also recovering your fixed cost. Till that time there is no profit, no loss. See, above break even points, once you reach the break even point, you only recover the variable cost, because the fixed cost is again fixed, right? You already recovered the fixed cost in the break even point. Till the time you are making 60% of the sales, you are continuously recovering the fixed cost. The moment you cross that fixed cost, the moment you cross that break even point, the margin of safety will come, and the margin of safety we will recover only the variable cost, and remaining all is your profit. That is an important concept you need to be aware. So coming to the question once again, they said 7.2 lakh will be the projected sales for the next year, right? So you know what is the sales you are projecting. So that is a value. So value, how do you get the value? Value you will get it from number of units multiplied by selling price, right? So selling price, is it given? Selling price is also given, how much reduction they want it. Okay, so which means how many units they are going to sell is also given here. 3 rupees is the existing selling price. 4 rupees is the existing selling price for Flash. So, and one more thing, maybe if someone is watching these videos for the first time, costing is not about solving 1 or 2 questions in the book. Okay, so you'll end up feeling messy in the examination. The only reason is that the same kind of questions would not be coming in the examination hall. There would be different set of questions. It's more about how analytical you are in your mind. Okay, so you need to, when you read the question, you need to understand what is given in the question, what they are asking, what I have to arrive. These 3 things we have to be absolutely clear. So now they have given the what is the existing selling price. They also said what is the reduction in the selling price. They have reduction in the selling price. So once you calculate that, the calculation is very elementary, that you can able to do it on your own. But the point here is existing selling price is given, what is the reduction in the selling price is given. So you will know what is the new selling price. Yes, I will know what is the new selling price, and I will also know what is the expected or estimated sellings for the next year. So when I know what is the estimated total sales divided by new selling price, I will get what is the number of units that I need to sell in order to get 7.2 lakh of this product and 3.5 lakh of the second product. You are understanding the mindset behind the calculations. Calculations is there on the study material. It's nothing new for me to explain here, or anybody can tell. But the thing that you need to master yourself is what is given in the question, what formulas I know, and how I can use these formulas for the existing question. That's it. So you should know what is the number of units that you are going to sell, right? So total selling price divided by new selling price, you will get what is the total number of units you need to sell. So in that way, this have done it here. New selling price 2.4 and 3.5, existing selling price, say you just deduct that whatever is the reduction in the selling price, and they have also given what is the estimated sales that they want to make in the next year, 7.2 lakh and 3.5 lakh. So you are getting 3 lakh units and 1 lakh units respectively. Means you need to sell 3 lakh units of A and 1 lakh unit of B in order to get such sales. That is also fine. But again, in the question they said that my break even point is at 60% of the sales. So of these 3 lakh units, 60% will be 1.8 lakh and 60,000. This is my break even point. But the point, you try to understand the crux of it. So you know the break even point, you know the what is the total sales, you also know what is the margin of safety. What do you mean by margin of safety? So I'll explain for product 1. See, my total sales are 3 lakh and they are saying my break even point is 1 lakh 8, which means that the remaining 1.2 lakh is only 1.2 lakh is only my margin of safety, which means that during that 1.2 lakh sales, I will recover my variable cost and remaining is all my profit. That is needs to be there in the mind. So I know my margin of safety also. So from the estimated sales, by using the new selling price, I have arrived what is the total number of units to be sold. From that, I have arrived what is the break even point sales, and I also arrived what is the margin of safety sales. This much is clear, step number 1. Okay. Now we need to find out what is the PV ratio. So what is the PV ratio? PV ratio is variable cost divided by sales. I know that, but variable cost nowhere in the question it is given. It is nowhere given in the question. But again, this comes the smartness of how you will use your existing formulas. At margin of safety, like during the margin of safety, you will recover only the variable cost, remaining is all your profit. Okay. So margin of safety number we know 1.2 lakh and 40,000. So 1.2, I will explain for 1.2 lakh, you know what is the margin of safety. Margin of safety multiplied by new selling price, you will understand what is the sales you are making in the margin of safety. So that is this much, 2,88,000 and 1,40,000 is the sales that you are making only for the margin of safety. And they said that I want a profit of 69,120 and 17,500. So from the total sales during the margin of safety, if you are removing the profit, so which is remaining is only the variable cost, no fixed cost. I just explained the concept. If this is my total sales, till break even point I will recover my fixed cost, right? So once I recover my fixed break even point, once I cross my break even point, remaining I will only have a profit, variable cost plus profit. So if I know what is the total sales, from that I will remove the profit element, so remaining is my variable cost. So now I got what is my variable cost, 218,800 and 12,002 or 122,500 is the variable cost. So variable cost divided by sales will give you the PV ratio. Just now I said that is the basic formula. So we know that what is a PV ratio. So again, it's not again a by heart kind of a thing. It's more about using your techniques and skills. Yeah. So now come to the main statement that we have started. We know what is the sales to be made in the next year. Yes, I know what is the variable cost. Just now I said it that 76% and 87.5%. So that is 76% is the PV ratio, which means that 24% is a variable cost. So directly you can multiply, either way that will be fine. So multiplied by 76% will give you 172, 800, and 87.5% will give you 43,750. So now you got sales, you got variable cost, you got contribution, as a case may be, and you know what is a fixed, what is a profit that you are expecting, 69,120 and 17,200. So contribution minus fixed cost will give you contribution. In the same way, contribution minus profit will give you a fixed cost, right? So it's just interchange. It's like sales minus variable cost, you are having contribution minus fixed cost will give you profit, right? So if I want to know what is the profit, I will deduct fixed cost from my contribution. But if I know my profit, what I can do, contribution minus profit will give you fixed cost, right? So it's just interchange. So that way I should be having fixed cost of 1,03,680 or 26,250 as a fixed cost, but existing fixed cost is 1,08,000 and 27,000, which means there should be a reduction of 4,320 in product A and 720 in the product B. Now the question, they are having three types of questions. Question number one, what should be the number of units you should sell? At the end of the question, end of the answer, whenever you are doing so much of calculations and workings, don't forget to write like, okay, what is the number of units they have asked? They are asking what is the number of units to be sold. So first for that you should write 3 lakh and 1 lakh. That is the answer. And then they are asking what is the break even point units. Break even point unit is 1,08,000 and 60,000. That is the second. Third one, what should be the reduction in the value of the fixed cost? So that should be 4,320 and 750. So for the examiner, for the valuer, the number should be visible all at once at the end, so that he will feel that okay, you have done a good work. Otherwise he will not take the pain in searching where you have given the answer, though it is right. Hope that is clear. My point here is not to tell the answer for one question, it is to make a mindset of how to solve costing problems. So we are going to the next question. Question number 2, pay attention, okay. This is a company who is having a sale of 5 lakh rupees and they are having a direct material of 2.5 lakh, direct labor of 1 lakh and variable overhead of 4 lakhs and capital employed is 4 lakh. Sorry, variable overhead is 40,000, capital employed is 4 lakh. Okay, so this is the information. So when they are giving the information, it's more like a chess game. What they have given, so this is they have given, and one manager is coming and is proposing that at the moment profit is 12.5% of the capital employed. At the moment the company is earning a profit of 12.5% of the capital employed. What is the capital employed? 4 lakh. So 4 lakhs may multiplied by 12.5%, you get some value. So that is a profit that they are earning, okay. And the manager who is newly appointed and is very curious to increase the sales of the company is suggesting this. Next year I want to say I want an increase in the profit element of 23% on capital employed. I am not satisfied with the 12.5%, but for that I will increase the sales value by 10% and selling price by 4% and cost reduction by 2%. So he's more hypothetical in this way. He's saying that I will sell more products. Okay, you sell more products, I will increase the price also. How it is possible? Maybe there is a demand for the product, we don't know. And he said that by doing some re-engineering and some revamp in the production model, we will decrease the cost of the product by 2%. Okay, so that is also fine. So now these are the information. Now you just have to tell whether his contention or his proposal that by reducing the cost by 2% and increasing the volume by 10% and selling price by 4%, will he be able to achieve the desired results? That is the question. 4 marks. So first you need to understand what is the existing system. Sir, why we are need existing system? From the existing system, you have every information, right? You have the sales, you have the variable cost, you don't have the fixed cost, but that can be a balancing figure. That should be your mindset. That can be a balanced figure. You have the profit also. So you have sales, you have variable cost, fixed cost is not there, that will be the balancing figure. You have the profit. So from this information you will calculate for the next year. Unless you do it for the present situation, it is difficult for us to do the next projected or whatever this proposal given by the manager. So sales, I'll write it here, 5 lakh Okay, where did I write? Okay, did not write here only. Fine. Sales 5 lakh, variable cost 2.5, direct labor 1 3.5, 3.9. So variable cost 3.9 lakh. So 1.1 lakh will be the contribution. So contribution 1.1 lakh divided by 5. So 22% is a PV ratio, 78% is a variable cost. So that much information we got it. That much information, I think somewhere I wrote, maybe I did not take a copy of that. Okay, no issues. Two 2.5, 3.5, 3.9. Profit they have already given, existing में 4 lakh multiplied by 12.5%, 50,000. So fixed cost will be 60,000. This will be your balancing figure. Okay, so these are the basic elementary things, but we still need to be clear on this. Yeah, so what we got what is the variable cost percentage, we got the fixed cost. Now they are proposing I will increase the sales volume by 10%. volume matlab number. So 5 lakhs is the existing sales. So when you want to increase the sales volume, multiplied by 1.1, this is for volume, and you want to increase the selling price by 4%, 1.04 is for the selling price. So now this will be the estimated sales for the next year. And coming to the variable cost, pay maximum attention. When I say PV ratio is 22%, which means that the variable cost is 78%. This is a very basic, right? So now 5 lakhs is a present sales, increase in the volume by 10%, which means 1.1%, multiplied by 78%. 78% is a variable cost. So you might ask, what about this 1.04% which you have considered for sales? See, now I am selling this product at 100. Next year I will sell it to the product at 100 multiplied by 1.04. So I will sell this product next year at 104 rupees. So does it mean that the number has increased? When the number has not increased, why should I increase the variable cost for this particular product? Put it other way, variable cost is a cost that will increase with the increase in the number. So whenever there is an increase in the number, only then the variable cost will increase. If I increase the selling price, does it mean that I will variable cost per unit also will increase? No, right? So that is the reason why this 1.04 will not come. Don't make that mistake. Again, I am telling, variable cost will vary according to the number of units that you are making or selling, but it will not have an impact, or it will not get changed if there is an increase in the selling price or decrease in the selling price. It will vary with the volume, not with the selling price. So that is the reason why 1.04 we will not consider. So 5 lakhs is the existing sales, multiplied by 1.1. 1.1 is for the increase in the volume. Okay, and 78% is a variable cost per say variable cost percentage. So we got this much. So contribution we got. Fixed cost, they said, okay, one more thing, this 2% is also very important, guys. Don't make this, they said that there is a decrease in the cost by 2%. So cost here is not specifically saying which type of cost, he's saying all cost. So when he said all cost, there is a decrease of 2%. So entire variable cost, whatever you calculate, usme se just deduct 2%. Okay, the same way fixed cost we got existing as 60,000 minus 2% will give you 58,800. So now the profit will be 92,780. So that will be the profit. This is very basic, right? And the capital employed is 4 lakh. So now you calculate 92,780 is the profit divided by capital employed 4 lakh. So it is giving you 23.195%. But what is he saying? I want 23% as my capital, 23% of my capital employed as my profit. But we have exceeded that, right? Then you can say that the proposal of the manager should be accepted. proposal of the manager should be accepted. Coming to the next question. There's a company who is anticipating a sales of 4 lakhs. We will be speeding up a little bit from now, since you got the essence of how the session is going to be. This will be in the same way. We'll be going fast with the concepts, not with the calculations. There is a company who is anticipating a sale of 4 lakh rupees. Selling price is 20. Direct material rate is given. Direct labor is given. Variable overhead is given. So these are all variable things. And net profit is 5% of the sales. That's also given. So there is a proposal to improve the profitability. They want to increase the profitability. So there are 4 proposals. One is administration cost. They want to reduce by 12,000. This 12,000 administration cost, you just reduce that. So whatever the profit that you get minus 12%, 12,000, that will be your answer for the proposal number 1. Next, proposal number 2, cost reduction 1 rupee per unit. So wherever there is a variable cost, wherever there is a variable cost, you decrease it by 1 rupee per unit. And that is the proposal number 2. Proposal number 3, units, you sell more units 20% and selling price 5, decrease by 5%, which means that you reduce your selling price by 5% so that more people will feel it is affordable, and 20% there will be increase in the sales. Or otherwise you do one thing, you increase the selling price, but when you are increasing the selling price, the market will not accept that. So there will be reduction in the units by 5%. So out of these 4 alternatives, you tell which one is the best one. So whenever they say that which one is the best, you first start with whatever is there existing. From that only we will come to know various other things also, or should we go with the proposal or not also. That decision will be based upon what is your existing profit, right? So existing profit may sales is given. So it's always a format is same, guys. Sales minus variable cost, contribution minus fixed cost, profit. That's a basic thing. So maybe there will be slight variation depending upon the question, but the moment you start the answer, that should be in the same format. So you will come to know various things, that what is missing in the question. So you will make a separate working note and complete that and come back to this main thing. Yeah. So in this question, sales is given 4 lakh. Variable cost, variable cost is 9 plus 3 plus 3, 6, 15. So variable cost per unit is 15. So 15 multiplied by 20k. So 20k, how do you know it is a 20k? How many units you are selling? You don't know. But the sales is given 4 lakh and the selling price is given 20, which means that 20,000 units they are making a sale. So that information is, just now I said, you first start with one format, and there will be some things that will be missing in that sheet. Like to calculate that, there will be certain things that you will be missing. You just leave some space, you create one working note, you complete then and come back. So that's where you can play with this. Yeah. So 20,000 units you are making sale, and variable cost per unit is 15. So you will come to know what is your total variable cost, 3 lakh. So you know what it will be your contribution, 4 lakhs minus 3 lakhs, 1 lakh. And fixed cost is nowhere given in the question, right? So fixed cost is not given. So don't feel disheartened by just not finding one piece of information in the question. That will be hidden somewhere else also. So net profit is given. So net profit is given 5%. So 4 lakh multiplied by 5%. So 20,000, you know. So 20,000 is a profit. So 1 lakh is a contribution. 20,000 is a profit. So fixed cost is 80,000, which is balancing figure. That's again the balancing figure can be either other things. It can be fixed cost, it can be profit, depending upon the situation. So 20,000 is the alternative existing profit. What they're saying, the alternate number 1, administration cost reduce it by 12,000. So when you reduce the administration cost by 12,000, your profit will increase by 12,000. So existing 20,000 plus 12,000, sorry. 12,000, right? So existing 20,000 profit, and you are reducing the administration cost by 12,000. So the revised profit will be 32,000. You can create the format one more time, just like sales minus variable cost, contribution minus fixed cost. Fixed cost may you reduce 12,000. So you will get the new fixed cost and then profit. But directly, if you want to write because of lack of time or anything, you can say that 32,000, 20,000 existing plus reduction in the fixed cost by 12,000. So 32,000. Next, cost reduction 1 per unit. So they want to reduce the cost per unit by 1 rupee. So existing it is 15 rupees. So now it will be 14 rupees. Okay. So sales, it's already given. So you are not playing with the sales. Variable cost 20,000 units are same. Instead of 15, you are multiplying by 14. So you are getting what is the variable cost. You are getting what is the contribution, and you are getting what is the fixed cost. Your profit will be 40,000 in the option number 2. It's a very easy, guys. It's more about how confident you are with your basic concepts. and decrease the selling price by 5% and increase the units by 20%. So in this case, you know what is your existing number of units that you are selling? 20,000. Just now we calculated 4 lakh divided by 20. So 20,000 is the number of units that you are selling at this point of time, and there will be increase of 20%. So whenever there is an increase of 20%, just do like this, 1 multiplied by 1.2. So that will be increase of 20%. 2, and reduce the selling price by so reduce the selling price by 5%. So selling price, we know what is the selling price, 20. So 20 selling price may say you are reducing it by 5% minus 5%. So 19 will be the revised selling price. It's very again basic things. Existing quantity of existing volume of units, you know, or it is an increase in the volume 20%. So multiplied by 1.2. Okay, and what will be the selling price? 19. Selling price 19, so multiplied by 19. So you are getting what will be the revised sales minus variable cost. Here little bit focus is required. Existing units are 20, so there is an increase in the volume by 20%, so it is becoming 24,000. So only 24,000. The selling price will not have effect on your variable cost. As I said in earlier question also, increase in the selling price or decrease in the selling price does not have any involvement or any impact on the variable cost. Okay, so it is 15 rupees. So sir, you said 14, so that is for alternative 2. So when you are doing anything, you again do with the main original question, not with the any other alternatives. See, in original question the variable cost is 15 rupees, so you consider 15 rupees only. Don't say that sir, in alternative 2 there they said that there is a decrease of selling price. We are not doing combination, we are doing separately independent scenarios. Okay, so 15 rupees. So this is your variable cost. So this will be your contribution. This is your fixed cost minus again the same format. Every question the same, it will be same. So 16,000 will be the net profit after all these things. Coming to the fourth one, increase the selling price by 10%, thereby there is a reduction of the units by 5%. So 20,000 existing units. So whenever there is a number of units decrease, you multiply it by 0.95. So 5% is decreased, right? So you can simply say minus 5% also, it's the same thing, or you can say multiply it by 0.95. So and increase the selling price by 10%, so multiplied by 1.1. Existing selling price is 20. Increase by 10%, right? So multiplied by 1.1 will give you the new selling price. So this is your total sales. And variable cost there is 19,000. Why this 19,000? Because 20,000 is the existing number of units. There is the reduction of 5% minus 5. You are giving 19,000 is the number of units. Okay, multiplied by what is the variable cost per unit? Again, you go back to the main question. 15 is the variable cost per unit. So this will be your total variable cost, and this will be your contribution. This will be fixed cost, and this will be your profit. So out of all these fourth one appears to be having the more profits or the most profit. You can say that needs to be accepted. That's it guys. So this is just part number 1, and if you feel that this way you are able to solve more questions, or you are able to get more clarity, please let me know in the comment section. We are coming back with the more questions. I mean rather I'm planning to complete as many questions as possible before your examination, but I just want that confirmation or that opinion from you that these videos will be helpful for you, so that I can continue and make the remaining videos also. Even quantitative techniques also, we are coming with the questions relating to assignment, transportation, learning curve. So these questions also we are coming up very soon. So please let me know in the comment section that if these videos are helpful to you. Thanks for watching. Have a nice day.